Let me tell you about the greatest investment most Americans have access to. It's the S&P 500 Index Fund. You buy one thing, and you instantly own the 500 biggest, most powerful companies in America. Over the last century, it's returned somewhere around 10% a year on average. It has minted more everyday millionaires than practically anything else on earth. It is honestly about as close to a sure thing as investing gets. And yet, here's the part that should stop you in your tracks. Most people who buy it still manage to lose money with it or walk away with a fraction of what they should have made. How is that even possible? How do you lose with the best investment in the country? Well, today I'm going to give you the uncomfortable answer, and it's this. The problem is almost never the investment. The problem is the investor. The problem, and I say this with love, is usually you. Let me prove it, and then let me make sure it's not you. There's a term for this in the investing world. It's called the behavior gap, and it's one of the most important and least talked about ideas in all of personal finance. Here's what it means. Researchers have studied this for years, and they keep finding the same shocking thing. The average investor earns dramatically less than the very funds they own. The fund itself might return around 10% a year, but the actual human being who bought it walks away with only a fraction of that, sometimes barely half. Read that again. The investment did great. The investor did terribly, and the entire difference, that whole gap, was not caused by the market. It was caused by their own behavior, the buying and selling and panicking that they did along the way. Over a lifetime, that gap isn't a rounding error. It's the difference between retiring rich and retiring broke. Let me put it in dollars so it really lands. Imagine two Americans who both invest the same amount every month for 30 years. The first one just holds the index fund and does nothing. The second one has the same fund but keeps reacting, selling when scared, buying when excited. Even a gap of just 3 or 4% a year between them, purely from behavior, can mean the disciplined one ends up with 2 or 3 times as much money at the finish line. Same fund, same contributions, same market. Completely different life decided entirely by conduct. So, let me walk you through exactly how people blow it, because these are the 5 moves that create the gap. The first and most destructive one is panic selling in a crash. Here's how it always goes. The market is cruising along, everyone's happy, and then it drops. 20%, 30%, sometimes more. The headlines scream that this time is different, that it's all over. And regular people, watching their life savings shrink day after day, simply can't take it anymore. So they sell. They dump their shares near the bottom to make the pain stop. And then, as it always has, the market recovers and roars back to new highs without them. They locked in their losses and missed the rebound. That single move, selling low out of fear, has destroyed more American retirements than any market crash ever did. The crash didn't hurt them. Their reaction to it did. We've watched it play out again and again. In the 2008 financial crisis, the market got cut roughly in half, and terrified investors bailed at the bottom right before one of the greatest bull runs in history. In early 2020, the pandemic crash wiped out a third of the market in a matter of weeks. And again, the people who sold in a panic missed a stunning recovery that happened almost as fast. Every crash feels like the end of the world while you're in it. And every single time so far, the people who held on came out ahead of the people who ran. The second move is the flip side of the same coin, trying to time the market. This is the person who's sitting on cash, waiting for the dip, waiting for the perfect entry point, waiting for things to calm down. And they wait, while the market climbs right past them year after year. Here's the brutal truth about timing. Nobody can do it consistently, not even the pros. And the cost of sitting out is enormous because a huge chunk of the market's gains come on just a handful of the best days, and those best days often come right after the scary ones. Miss a few of them because you were hiding in cash and you gut your entire return. Time in the market beats timing the market every single time. The third move is performance chasing, and this one feels smart while it's quietly killing you. This is the investor who owns the boring index fund, watches some hot stock or trendy sector or crypto coin double and thinks, why am I sitting in this slow index when that thing is on fire? So they sell their steady fund and pile into whatever's hot. and they almost always show up late, right at the top, just in time to ride it back down. Chasing whatever went up the most last year is a reliable way to buy high and sell low, over and over. The boring fund was never the problem. Abandoning it for the shiny object was. The fourth move is subtler, but it fuels all the others. Checking your account far too often and letting your emotions drive. When you watch your balance every single day, every wiggle feels like a decision. A red day makes you anxious. A big drop makes you want to act. A hot streak makes you greedy. And emotional investors make emotional mistakes. The people who quietly get rich with the index fund are usually the ones who barely look at it. They set it, they forget it, and they let the years do the work. The obsessive checkers, the headline reactors, the tinkerers, they trade their way straight into that behavior gap. And the fifth move is simply quitting too early. Some people do everything right for a few years, but they don't see the magic happening yet, because in the early years, compounding is quiet and the account grows slowly. So they get bored or discouraged and they stop. They pull the money out, or they quit contributing right before the snowball was about to take off. Compounding rewards patience above almost everything else, and the people who bail early never give it the time it needs to do the one thing it's incredible at. So notice the pattern in all five. Panic selling, market timing, performance chasing, emotional reacting, quitting early. Not one of them is about the investment. Every single one is about the person holding it. The S&P 500 did its job the whole time. The investor got in its way, which is actually fantastic news because it means the one variable that matters most is the one thing you can completely control, your own behavior. So how do you win? You become boring, gloriously, profitably boring. Warren Buffett, one of the greatest investors who ever lived, basically tells regular people to buy a low-cost index fund, keep buying it, through thick and thin, and hold it for decades. That's it. That's the whole strategy, and it beats almost everyone. So here's how you actually do it. First, automate everything. Set up an automatic investment every payday, so the decision is already made and your emotions never get a vote. Second, when the market crashes, and it will, you do nothing, or better yet, you keep buying, because a crash is simply the best investment in America going on sale. Third, stop checking your account every day. Turn off the alerts. Look a couple of times a year, not a couple of times an hour. Fourth, don't chase the shiny thing. Pick your simple plan and stick to it while everyone around you is jumping from fad to fad. And fifth, give it time, real-time decades, and let compounding do what it does. Do those 5 things, and you close the behavior gap. You actually get to keep the returns the fund is handing you, instead of giving them away through your own mistakes. And here's the beautiful irony of all this. In most areas of life, doing more gets you more. Investing is one of the rare places where doing less wins. The person who trades constantly, reacts to every headline, and tries to outsmart the market usually finishes behind the person who set up an automatic plan and then went and lived their life. Your job is not to be brilliant. Your job is to not get in the way. Build the system once, then let your discipline, not your emotions, run it. So let me bring it home. The S&P 500 is one of the greatest wealth building tools ever offered to ordinary Americans, and it will very likely keep doing its job just fine. The question was never whether the investment works. The question is whether you'll get out of its way. Most people won't. They'll panic, they'll tinker, they'll chase, they'll quit, and they'll blame the market for a wound they inflicted on themselves. But now you know the game. Be boring, be automatic, be patient, and let the best investment in America actually make you rich. And since markets and numbers always change, do check the current details before you act. If this hit home, hit that like button and subscribe so you don't miss the next one. I'll see you there.